straight to the top story this evening. The Reserve Bank wants to impose tougher rules on banks lending to large corporates. Now, the central bank has essentially put out a discussion paper this evening. The paper proposes limits on large loans to curb the concentration in a particular sector. Latha joins us now to help us understand what this means. Latha, in plain English, what does this mean now as far as bankers are concerned who are lending to large corporates? What does it mean to conglomerates and their ability to borrow from banks? What is this going to mean finally as far as the economy is concerned?
Well, the Reserve Bank is definitely looking at making the banking sector take lesser exposure to the already leveraged groups. What the Reserve Bank's discussion paper argues is that currently there are limits to how much one bank can give one corporate. They can't expose themselves beyond 25% of the bank's net worth. But there are no system-wide limits on how much one borrower can take. So some of these over-leveraged groups have borrowed from all the 60 banks and therefore are highly leveraged, increasing the systemic risk to the banking sector. So what are the new rules that the Reserve Bank is proposing? It's only a discussion paper again, that some specified groups be identified. These are groups which have system-wide loans over 25,000 crores as of 2017-18. Now, what the Reserve Bank says is that if any of the banks want to increase their exposure beyond 25,000 crores to one group, then the amount of provisioning should increase from 0.4 currently for good loans to 3%. As well, the capital weight, the risk weight, should rise to 75 basis points. So this will make the banks, a little more alert while taking these exposures, because they have to pay a price for it through higher provisions. Also, what RBI is saying is that whatever extra that banks have by way of loans, they could convert it into bonds. And by the year 2018-19, they should sell off these bonds up to the extent of 30%. And by 2019-20, 60% of the bond exposure should be sold off. And by 2021, the entire 100% should be sold off. Basically, the Reserve Bank is giving the entire banking system and the highly leveraged corporates time up until 2021 to bring down the overexposure limits. The key takeaways from this would be that life becomes a little tougher for banks because they have to do higher provisioning. For highly leveraged borrowers, life will become tough because banks will refuse to lend to them. And for the system as a whole, there could be the advantage of less systemic risk for the banks, but more importantly, a forceful creation of the corporate bond market. When there is no other way to borrow but through bonds, then possibly this elusive corporate bond market will evolve. That's the rules proposed. There will, of course, be changes before they become finalized.
Well, Latha, thanks very much for explaining that to us. I'm going to come back to you on what's been a bad day for the macros. That's in just a bit. But joining us for a quick reaction on the story that we were just discussing is the Executive Director of IDBI Bank, Mr. Bansal. Mr. Bansal, appreciate you joining us here on CNBC TV 18. It's a discussion paper at this point in time, but a plain reading of this seems to suggest that lives of bankers are going to get a lot more complicated. At least that's what some former bankers seem to be suggesting. What's your take on what the Reserve Bank has said?
I agree that because of this guideline, certainly life will be difficult in the sense that banks have to track what is the total exposure of the banking system to a client. If you remember last time when RBI introduced this, issued this paper for discussion, that time there was no talk of banking sector-wise exposure limits. There was a talk of bank-wise group exposure limit instead of individual client exposure limit, etc., etc. So now, having put these limits of 25,000 crore or 15,000 crore, 10,000 crore, the idea is that it's taking forward the system which RBI has introduced under CRIL C. So that banking system is aware how much exposure banks are taking to each client.
But how realistic is this business of actually creating a forceful bond market, sir? As Latha was pointing out, I mean, it's elusive. We've been talking about it for years now. But do you believe that this is now going to lead to that forceful creation?
At least it will move banks towards looking at the bonds market. As of now, banks have normally been thinking always about advances and rather bonds. But one issue which certainly will come, that most of these leverage groups, perhaps the rating could be an issue for these bonds. So that could be a
You're
difficulty.
absolutely right.
where-
That was a point
yeah.
that Pradeep Chaudhary raised as well, Mr. Bansal. Finally, what is it going to mean for large conglomerates and large corporate houses? You know, we've got the Bank Board Bureau meeting public sector bankers tomorrow, asking them to lend more to kickstart the economy. You've got this Reserve Bank discussion paper on raising the red flag as far as lending to leveraged groups are concerned. How do you balance all of this out?
I agree, it's a difficult call, but I think maybe once economy improves, then corporates will also be forced to move towards the bond market, or they have to look towards raising more equity or overseas borrowing, etc. I think, in some way.
Well, those are the options that they will have to consider. But appreciate you joining us, R.K. Bansal, Executive Director there of IDBI Bank. Well, as I was